Hello, yes, good afternoon, everybody. I hope you can hear my voice and at the same time see my screen clearly. So today's webinar, I want us to look at certain chart patterns that are very, very profitable. We're not going to look at all of them. There are very, very many, but we want to focus only on 6 chart patterns that are always very profitable. That at least if you try to focus on them, if you look at them, if you try to master them clearly, then you're going to get exactly what you're looking for. So I want us to start first of all with some few general ones. We're going to look at 6 in number, but I want us to look at some of them, the ones which are most profitable and the ones which most people do use. So the first chart pattern which we're going to look at the converging wedge formation. So from the name converging is coming together. That is, if you have a line like this and then you have another one, so what happens first is the first thing that happens is the price goes up to this point and then it goes down back. You can see that the price comes from this point here, goes up, it reaches this point, then it goes back down, then it goes back up, and then it reaches this point, then it goes down, and then when it hits the lower trend line, it again comes back up. Then when it hits this upper line, then it again goes down. Then maybe it can break below that line, or it may pause there, then again continue up and go and break above the upper line. So in this case, we are actually having a very good converging wedge formation. That is, as the price continues to move into the future, the shape of this wedge, the height between the lower and the upper line begins to decrease. It begins to decrease, it begins to decrease, it begins to decrease until when the price breaks and closes above, either above or below this trend line. So this becomes a very good converging wedge formation. This is a very, very good converging wedge formation. So if you don't know exactly how to find this clearly, if you can't make it out where the price is, if you can't know it clearly, you can use this indicator. This is the zigzag indicator. You may use it, just put it in a chart, use its default settings. The default settings for the zigzag indicator is 12. The depth, that's the setting for the depth, is 12. Deviation is 5. Then back step is 3. So just the default setting, put in a chart, and you'll have something like this. Then we want to try and find now a converging wedge formation using the zigzag indicator. So look at this. It's not necessarily the best zigzag, but it's not the best converging formation, but you can see that it's actually converging. You can see that we had a resistance, we had a support, we had a resistance, we had a support. There is a break above that resistance. So right now the price is headed upwards. As it is now, it looks like the price is likely going to continue to the upper side. So we keep looking for buy orders. We are expecting that the buyers will continue to push price after the break above this shape here. So this right here, how the price is after this breakout, is usually a very good sign that we are now continuing upwards, and it means that this wedge has been invalidated, thereby the price will likely continue in that direction. We are going to get another converging wedge. So if you can't get a higher time frame, you can scale down to lesser time frame, like 5 minutes or 15 minutes. You'll get tons of them. So we have this. Then you have another. You can see that you're having a very, very good resistance level. You're having a very good converging wedge formation, and the price is broken, closed below it. So this is a sign that the price is continuing in that direction. We are having a very good converging formation. The price broke below it, continue downwards, and we do expect it to extend much lower. So that's another example of converging wedge formation. Let's see if it's another. This could be another one. Have that. Also have this one. So you can see we had a resistance, sorry, we had a support, we had a resistance, we had a support. It was very good converging. The price broke and closed above it. So anytime this happens on a chart, anytime you notice that the price is beginning to consolidate within a given area, you should always try to get the extreme line, the upper line, and the lower line, then wait inside the range. Then when the price breaks and closes above this upper line, expect that the price will continue upwards, or if it breaks below, expect that the price will continue to the lower side. So there is another converging wedge here. This is another one. Doesn't look very good, but it's still a converging wedge formation. You can see it's converging. This is bigger than this. This is smaller. This is even smaller. So this is a shape. The price broke and closed below it. So after the breakout, this was a good sign for a sell. You were supposed to be taking a sell position. Are we on the same page? So those are some few examples of the converging wedge formation. The other one is the expanding wedge formation, which is now opposite of the converging wedge formation. Expanding is where we have price start from smaller diameter, this level, and the diameter continues. So we take this as like some circles, some circles, some circles. You can see the circles expanding, they keep expanding, they keep expanding. And as the price is expanding, it doesn't expand indefinitely, but it expands up to some point where the price actually breaks below or it breaks above this upper line. So the price will go inside, then begins to oscillate inside it. You can see that the price is going up, it's coming back down, then it goes up, then it comes down. So usually when this starts to happen, when you notice that this is what is happening, there are two things you could do. You may just sit aside and wait for price to either break above or break below. The price may break below this line, then continue downwards, or the price may break above the upper line, then continue upwards. So as I've mentioned, you may wait for two things to happen. Either the price breaks above or the price breaks below, or you may just go ahead and start selling from the top and buy from the bottom, sell from the top, buy from the bottom, sell from the top, buy from the bottom, sell from the top, and buy from the bottom. So the main question will be, if I buy here, where will my stop loss? Because I already know that the take profit will be here, but where will the stop loss be? So place your stop loss according to the distance you had before. So if the distance from this to this was maybe 20 pips, just have your stop loss that distance. Or you may fix some values to it. It doesn't have to be some small value, but because we don't expect price to go here below. You can say, okay, I expect the price to go upwards, but if it closes below, we will expect it to go downwards. So what to do when you buy here, let the price float. If any candle does close below this line significantly, step out of that trade. But if the price goes up and hits this trend line, just also step out that. So that's a sign that we are now hit our take profit. We're supposed to step out of everything. Does that make sense? Does that make any sense? That if you buy there, have your stop loss float, or you may place it but have it very long distance, such that if in case the price spikes down, does not hit your stop loss unnecessarily, but if it closes below this trend line, then I do recommend that you just step out of that trade immediately. Does that make sense? All right, so now this is the template for it. Let's check it on a real chart. This is how it looks. So you may find it very difficult to see it, but they are actually there. So just have to get like this one. It's expanding. It's also expanding from here. So you can see as the price progresses in the future, it keeps expanding, and eventually it broke below it. So this is why I was saying, if you're that person who you're trading reversals here and you pick a buy here, then the price goes down and closes below. If your stop loss was even 20 pips, just step out of it. If already it has not taken a stop loss, then just step out. Don't wait for anything. Can you see it? Looks very clear. This is a very good typical example of an expanding range formation. It expands into the future. So the diameter, if you take this as circles, the diameter keeps increasing until when the price breaks up below that shape. So another thing is, somebody may ask me, okay, how after this breakout and we enter sell, where do we have our stop loss or where do we have our take profit? Have your stop loss along this line here, then step out just when you're in enough money. So don't wait for anything. But when the price goes your way, just step out when you've gotten a good number of pips. Just step out and let the chart continue in the direction it wants to continue to. The other one, this is another expanding range formation. You can see it is expanding into the future, but for some reasons here the price it actually attempted to break above it, but that was too late. So you can see that it attempted, it closed above here. If you took this entire place as the expanding formation, then you can see here that the price actually broke and closed above that level there. So you can see that the price indeed closed out, it went above it, broke above it, continued much higher. So let's check another one, another expanding range formation. So this is why I was saying that whenever you're trading expanding formation, just ensure you step out of a trade as quickly as possible. Like here the price broke above, then it went just slightly upward. This is like this could be like 10-20 pips before eventually it went down. So if you are expecting like 200 pips here, this could not have gone correctly. So you just step out when the price has made just a good amount of money. You step out and let the trade continue in the direction that it chooses. So those are just two that we've looked at. I want us to look at another one, which is triangular formation with a flat base. So what triangular formation flat base means is this: we have a resistance or support, and then we have something like this. So it's like the price went up, and then from this point it went down, and then it went up, and then it went down, and then it went up, and then it went down. So you can see here we have a flat base, and then there is this diagonal line. So here it's like this more or less looks like the converging range formation, but it's not the same, because with the converging range formation we have, this is not flat, the base is not flat, it is diagonal, the upper one is also diagonal, but this is flat. So this is a buy, this is a buy, this is a sell, this is a sell, this is a sell. You may as well be buying anytime the price touches this base but does not break below it. But when the price breaks below this base, then expect that the sellers will continue to push price in that direction. Or when the price pulls back upwards, then along this trend line is a good place to look for a sell from. Are we on the same page? Does this make sense? So it's not always very easy to find. It's not always very easy to find, but it is there. It's there. You can find it. It is there. It is possible when you look at it. You can find it easily. You can find it when you look at it, but mostly it's never there. It's there, but rarely there. And the other one is where we have the same scenario. Then the price goes down, and then it begins to use this level as a resistance. So now it uses the same level which was using as a support to form the triangular formation. It now uses it as a, so this will be goes way down, then it begins to get the circles begin to get smaller as the price progresses into the future. So something like that. You can see that the price keeps going, it keeps getting smaller, and it goes up, it gets even smaller, then it goes up. So until the price breaks and closes above this line, then that is now a sign that we may see the price extend in that direction. So the idea here is to wait for price to break above this line. If it pulls back to the same level, then this will be a good place to look for a buy from. That makes sense. Does it make sense? So those are 4 cases we've looked at. The other chart pattern is actually based on candles, where you have, it's like we have one big candle showing that the price is going to continue in that direction. We have, it could be red candle. Then we have another candle here. This candle is almost similar, could be the same color. Could be the same color. Then we have this. So we have that. Then you have another one. And this is almost as big as this, but it's not the same color, it is green. So in a case like this, what this simply means is we are likely to see the price extend to the upper side. It's a very good sign that if you can learn how to master it, then you will get very good signals. Have that. So you can see here we have a common base. We have the base here where it's like a support. Then we have this candle being very big, and this candle being almost 3/4 of the bigger one. So what this means is that the price is continuing upwards, will likely extend to the upside. So keep looking for buy orders. Expect a break and a close above this line. So expect the price to go above this line, 1.08574. Expect the price to break and close above it before it can extend to the upside. So whenever you see a scenario like this, always a very good reversal pattern. What it simply means is that we are likely to see the next candle, likely to see the next candle continue to the upper side, not entirely